Hello, I just wanted to finish Chapter 7 lecture. We had started with a variable growth rate model. This company had just paid a dividend of $1.50. The growth rate would be 10% for the next 3 years and then 5% for the foreseeable future. The required return is 15%. So we calculated the dividend for every single period during the variable growth rate period and one period after. That's what told us to calculate dividends to time period 4. We were then able to use the constant growth rate model right here in the bottom left, where the price at time period t is equal to the next dividend payable over r minus g. So the price at time period 3 is equal to the dividend at time period 4 divided by r minus the constant growth rate. And the constant growth rate is 5%. So that gives the price at time period 3 of $21. So now we can ignore everything that happens after time period 3 on our timeline because we've already captured that in the price at time period 3. So now we're ready to set this up into our cash flow worksheet so that we can get the present value of these dividends. So you use the cash flow button on your calculator. It's located right next to the second button. We have because we're going to calculate the present value, we're going to use the net present value function. So our cash flow at time period 0, there's nothing above the time period 0 here. Remember, we never ever include D0. We assume that it's already been paid and we don't include it in our calculations. So cash flow at time period 0 is 0. Cash flow at time period 1. At time period 1, we only have one cash flow associated with that, and that's dividend 1 of $1.65. Cash flow at time period 2, there's only one cash flow associated with the second time period, and that's dividend 2, $1.82. And at time period 3, there are two cash flows associated with that time period. We have both the dividend and the price of the stock at time period 3. So we have dividend 3 plus the price of the stock at time period 3. So 2 plus 21 gives you $23. Now you push the NPV button. Enter in your interest rate as the 15% required return and solve for the present value. Okay, so push cash flow to clear your cash flow worksheet. You push cash flow and then second and clear work. Our cash flow at time period 0 is 0, so enter and the down arrow. Cash flow at time period 1 is dividend 1, $1.65. Enter and the down arrow, frequency of 1. Cash flow at time period 2 is dividend 2 of $1.82. Enter and down. And cash flow at time period 3 is $23, so 23, enter. Now we push the NPV button, enter in our required return, and compute. And we get $17.93. So $17.93 is the value of this common stock. If you had a graphing calculator, it would have been NPV, open parentheses, your discount rate of 15, comma, cash flow at time period 0 is 0, comma, braces, 1.65, comma, 1.82, comma, 23. Close braces, close parentheses. and enter. And you should get $17.93. We can also value common stock using the free cash flow valuation model, where the value of the entire company, VC, value of the entire company, is equal to the present value of all future free cash flows. We discount that using the weighted average cost of capital. Free cash flow is the amount of cash available to investors once all obligations have been met. But the free cash flow valuation model does give you the value of the entire company. So to get the value of common stock, the S, you have to subtract off the value of debt and the value of preferred stock. So here's an example. Here are the free cash flows. Starts at $400,000, goes up to $600,000. The growth rate beyond 2017 is 3%. The weighted average cost of capital, or the discount rate, is 9%. The market value of debt is $3.1 million. The value of preferred stock is $800,000, and there are 300,000 shares outstanding. So now we're going to pretend that this is not old, that it is 2013 right now. And we're going to calculate the value of these free cash flows. I'll try to make this more simple to understand. So that's time period 1, 2, 3, 4, and 5. And beyond time period 5, it grows to infinity. That should make it more simple, so you don't get thrown up on years, since this data is old. So at time period 0, remember, we don't count anything for time period 0. Time period 1, free cash flow is $400,000. Time period 2, cash flow is $450,000. 500, 560, I'm sorry, that was 520. 560 and 600. 400, 450, 520, 560, 600. And after time period 5, it grows at a constant 3%. So remember, we always calculate dividends or free cash flow to one period after where it becomes constant. So here it becomes a constant 3%. So 600 was our last free cash flow times 1 plus 3%. So that's 618. So now we can employ the constant growth rate model for time period 5. So the value at time period 5, remember we have the equation price today is equal to the next dividend payable over R minus G. We're applying this exact same formula. Except here we're just saying the value of the whole company, because the present value of free cash flows gives you the value of the whole company, not the value of common stock. Is equal to the next free cash flow divided by the required return. The required return is the weighted average cost of capital of 9%. Minus the growth rate of 3%, the constant growth rate. When you work that out, you should get 10,300. So now we can ignore all cash flows that occur after time period 5. We're ready to set this up in our cash flow worksheet. Cash flow at time period 0 is 0. Cash flow at time period 1 is free cash flow at time period 1 of 400. 450 for cash flow 2. Cash flow 3 is 520. And cash flow 4 is the free cash flow at time period 4. It's 560. And cash flow at time period 5 is the free cash flow at time period 5 plus the value of the company at time period 5. Now we can enter this into our net present value. With an interest rate of 9%, the weighted average cost of capital. If you have a graphing calculator, NPV 9, 0, braces 400,000. Remember, these are in thousands. 450,000, 520,000, 560,000, 10,900. Close braces, close parentheses. So now we're ready to enter these in. Push our cash flow button and then second and clear work. Enter in the down arrow. Cash flow at time period 1 is 400,000. Enter. 450,000. 520,000. 560,000. And 10,900,000. NPV, interest rate is 9. So that gives us a value of the entire company of $8,628,234. Remember, that's the value of the entire company. So if we want the value of common stock, we take the value of the company, subtract off the market value of debt of $3.1 million and the market value of preferred stock of $800,000. So the value of the entire company is $4 million, or of just the preferred stock, or just the common stock is $4,728,234. So if we want the value per share, we have to divide this by shares outstanding. So if we want the price, the value of common stock over shares outstanding. So we take the 4.7 million and divide it by 300,000 shares outstanding. And you get $15.76. So it's basically the same problem as before, just using a different valuation cash flow. There are other approaches to common stock valuation. First is the book value per share. This would be the value of common stock if all assets could be sold for their exact book value. This method may not be accurate because we are assuming that we can sell assets for their book value. In reality, if you're having to liquidate, your assets probably aren't worth their book value. But regardless, we can say that assets for Lamar Company were $6 million. Liabilities are $4.5 million, and there are 100,000 shares of common stock outstanding. So we can calculate the book value per share of common stock. If we have $6 million in assets, and we subtract off the liabilities, the $4.5 million, we're left with $1.5 million. And we divide that by the shares of common stock outstanding. to give us $15 per share of common stock. Liquidation value is much more realistic than the book value per share. Liquidation value is the value if all assets were sold for their market value. So instead of being able to sell their assets for the book value of $6 million, Lamar Company can only get $5.25 million for their assets. Remember, they had liabilities of $4.5 million and 100,000 shares outstanding. That means that their liquidation value, which is probably the amount that they would be closer to receive in the event of liquidation, is $7.50. The price-earnings ratio is the amount investors are willing to pay for each dollar of earnings. And we can use the price-earnings multiple to value our firm's stock. So you take your firm's expected earnings per share and multiply them by the average price-earnings ratio for the industry. So Lamar Company is expected to earn $2.60 next year. The industry has an average price-earnings ratio of 7. So the value of their stock would be $2.60 times 7 to give you $18.20 using the price-earnings multiple approach. There is problems with using earnings forecasts because companies have such an incentive to meet their earnings forecast. If they don't meet their earnings forecast, their stock price is going to tumble. And when actual numbers are higher than the earnings forecast, their stock price is going to jump. So there is an incentive to have good earnings. So you can achieve this in manners that may be unethical using earnings management techniques. So there are problems associated with price earnings valuation. It is fast and easy, so it is popular. But price earnings ratios can vary widely. One thing that you have to be very careful of is identifying your industry correctly. So you may say, well, I'm looking at Walmart. I want to value Walmart. Who would be in Walmart's industry? Kroger is in portions of their industry, but not all. So it's difficult to identify exactly who's a competitor. Walmart and Whole Foods, yes, they both sell food, but are they direct competitors? Probably not. So when calculating stock values, every decision that a financial manager makes impacts a firm's stock value. So if the decision is going to cause expected returns to increase or dividends to increase, or the growth rate to increase, it may also have an impact on the risk or the required return. So each of these factors have to be considered when making a decision. So any management action that could cause current and prospective stockholders to raise their dividend expectations should increase firm value. So if they can increase dividends without changing risk, they should take these actions. So let's assume that Lamar Company announced a major technological breakthrough. This is going to cause next year's dividend to be $1.50, and the growth rate is going to increase from 7% to 9%. And we'll assume that the required return is 15%. So the price today is equal to the next dividend payable divided by the required return minus the growth rate, 9% now. So 1.5 divided by 6% is $25. But any decision can also change the risk. So remember, the risk is equal to the risk-free rate plus a risk premium. If the company takes actions that are going to increase the risk premium, that can also have an impact on stock price. So let's assume that the new required return is 16% because the risk premium has increased. So the price today would be equal to the next dividend payable divided by the required return minus the growth rate of 9%. So now we have 1.5 divided by 7%. And that's going to give us a value of $21.42. So notice that by increasing our risk level, we have lowered the price of our stock. So let's assume that the growth rate hadn't changed. Let's say it was 7% still. So if the price today is equal to the next dividend payable over the required return minus the old growth rate, I just did the slides backwards. So 1.5 divided by 9% gives you $16.67. So here this shows you that by increasing your risk but not increasing your dividends, your stock price would be very low at $16.67. By increasing risk and the dividends, so increasing the risk and the growth rate, is $21.42. By increasing the growth rate alone, the value of this stock is $25.